It's November 22nd, 1910. Late at night, at a small, almost deserted train platform in Hoboken, New Jersey, a group of newspaper reporters stands in the cold. They've been tipped off. Something big is happening. They watch as some of the most powerful men in America slip quietly into a private rail car, blinds drawn, doors locked. The reporters shout questions. No one answers. The train disappears into the night. Those reporters had no idea what they had just witnessed. And when they finally found out, years later, they realized that on that cold November night, the entire financial future of the United States had just boarded a train to a secret island. Those men weren't going hunting. They were going to design the system that controls your mortgage rate, your savings account, your credit card interest, your paycheck's purchasing power, and every financial crisis that has rocked America since 1913. Think about the last time you checked your bank account and felt that quiet dread. The last time you looked at your credit card statement and wondered how the interest got so high. The last time the Federal Reserve raised rates, and you felt it in your wallet the very next month. Everything you've ever felt about money, that it doesn't go far enough, that the system is rigged against you, that the rules were written by people you never elected. That feeling has a birthplace, and it's a private island off the coast of Georgia. This is the story of Jekyll Island, and it is 100% real. To understand what happened on that island, you have to understand the world that made it necessary. It's 1907. America is booming, dangerously. Factories are roaring. New York is exploding with wealth, steel, railroads, oil, fortunes being built faster than anyone thought possible. The United States is on the verge of becoming the most powerful economy in the history of the world. And yet, underneath all of that growth, the American financial system was a disaster waiting to happen. Here's the problem. The United States had no central bank, no single institution that could step in when things went wrong, no lender of last resort, no backstop, no emergency brake. Between 1863 and 1910, less than 50 years, the United States suffered 3 major economy-wide banking panics and 8 more severe localized ones. The Richmond Federal Reserve documented all of them. The pattern was brutal and relentless. Every decade, roughly on schedule, the system buckled. People lost their life savings overnight. Banks that had done nothing wrong were shuttered within days. Businesses operating for generations simply ceased to exist. Farmers couldn't get credit to plant their crops. Factory workers were laid off by the thousands. Families were destroyed, not by bad decisions, but by a structural flaw in the system they depended on. Then came 1907, the worst one yet. The panic of 1907 started when a run on the Knickerbocker Trust Company in New York spiraled out of control. Within days, it spread like a financial wildfire. The stock market cratered, unemployment surged, healthy banks, institutions that had made sound investments, were being destroyed because terrified depositors were lined up around the block, demanding their money back. That's how bank runs work. They're self-fulfilling. Fear becomes reality. A healthy bank, drained by panic withdrawals, becomes insolvent. The contagion spreads. America was staring into the abyss. And then something extraordinary happened, something so dramatic it would never be allowed to happen again. One man saved the United States economy. His name was J.P. Morgan. Morgan was 70 years old, arguably the most powerful private citizen in American history. A banker so dominant that he had personally bailed out the U.S. Treasury in 1895 when the government itself was running out of gold. In 1907, he called the most powerful bankers in New York City into the library of his private Manhattan mansion, locked the doors, literally locked the doors and pocketed the key, and did not let them leave until they had collectively pledged enough money to stop the panic. It took days. Morgan barely slept. It worked. The panic of 1907 ended, but the lesson it left behind shook Washington to its core. The richest industrial nation on earth, the country building the Panama Canal, electrifying its cities, manufacturing more steel than Britain and Germany combined, had just been saved from economic collapse by one 70-year-old man in a private library. What would happen next time, when J.P. Morgan was gone? That question didn't just frighten politicians, it humiliated them. And it sent one man on a mission that would permanently change American history. His name was Nelson Aldrich. If you've never heard of Nelson Aldrich, here's who he was. Aldrich was chairman of the U.S. Senate Finance Committee, the most powerful financial politician in America. President Theodore Roosevelt called him the kingpin of the Republican Party. Journalists of the era had a less flattering name, the boss of the United States. He was spectacularly wealthy from investments in railroads, rubber, and banking, deeply connected to Wall Street in ways that would make modern ethics committees nervous. And crucially, his daughter Abby had married John D. Rockefeller Jr., the Rockefeller family, the dynasty that controlled Standard Oil and had its hands in nearly every major bank and railroad in the country. Aldrich was not a neutral observer of American banking. He was the definition of an insider's insider. After the Panic of 1907, Congress created the National Monetary Commission, a bipartisan body tasked with studying the broken banking system and proposing reforms. Aldrich was made its chairman. He took the job with unexpected seriousness. He spent nearly 2 full years traveling through Europe, studying the central banking systems of England, France, and Germany. He met with central bankers and economists across the continent. He came home with one firm conviction: America needed a central bank. But there was a political wall standing directly in his way. The phrase central bank was not just unpopular in 1910, it was radioactive. Americans carried a deep, almost genetic distrust of concentrated financial power. Thomas Jefferson had fought Hamilton's first Bank of the United States. President Andrew Jackson had waged an all-out war to destroy the Second Bank of the United States in 1836, and won. For 80 years after Jackson's victory, the very idea of a central bank had been treated as close to treason, a tool of elites designed to extract wealth from ordinary Americans and funnel it upward to the privileged few. Those fears weren't entirely unfounded, and Aldrich knew it. He also knew this: if a bill written by or associated with Wall Street bankers became public before it passed, it would die in Congress. The American public wouldn't stand for it, so he made a decision. He would gather the 6 most technically capable banking minds in America, every one of them with deep connections to the world's most powerful financial institutions, and remove them completely from public view, somewhere remote, somewhere the press could not follow, somewhere secrets could survive. He needed the perfect location. He found one: Jekyll Island, a narrow strip of land off the coast of Brunswick, Georgia, accessible only by private ferry, miles from the nearest town. In 1904, Munsey's magazine described the Jekyll Island Club, in the magazine's own words, as the richest, the most exclusive, the most inaccessible club in the world. The Jekyll Island Club was founded in 1886. The members who owned it, J.P. Morgan, William Kissam Vanderbilt, Marshall Field, had between them more personal wealth than most countries. The island wasn't just exclusive, it was invisible to the outside world by design. J.P. Morgan, almost certainly, arranged for Aldrich's group to use the facilities. The man whose private library had stopped the Panic of 1907 was now opening his private island so that a small group could design the system that would make such private rescues unnecessary. On the evening of November 22, 1910, Aldrich issued his invitations. The instructions were precise and unusual. Travel to the station separately. Do not arrive as a group. Tell no one where you are going. Board the private rail car alone, one at a time. And from the moment you step aboard, use only your first name. No last names. Not once. One of the men even carried a borrowed shotgun to sell the cover story of a duck hunting trip if anyone recognized them. They called themselves with dry humor the First Name Club. So who were these men really? Nelson, Senator Nelson Aldrich, Republican chairman of the Senate Finance Committee, son-in-law of John D. Rockefeller, the political power at the table. Piet, A. Piet Andrew, Assistant Secretary of the United States Treasury, the official voice of the federal government. Inside a secret meeting the government didn't officially know was happening. Henry Davison, senior partner at J.P. Morgan & Company, the direct representative of the most powerful private banker in American history. Frank Vanderlip, president of National City Bank of New York, the institution you know today as Citibank, one of the largest banks on earth. Arthur Shelton, Aldrich's private secretary, the man who would keep records and ensure nothing leaked. And then there was Paul. Paul Warburg was born in Hamburg, Germany, into the Warburg banking dynasty, one of the oldest and most distinguished private banking families in European history. He had worked at houses in London and Paris before emigrating to New York in 1902 to join Kuhn, Loeb and Company on Wall Street. For years before Jekyll Island, Warburg had been sounding the alarm publicly. In January 1907, months before the panic that proved him right, he published a piece in the New York Times warning that America's banking system was at about the same point as was reached by Europe at the time of the Medici. He was not being hyperbolic. He was saying the United States was operating a 15th century banking system inside a 20th century industrial economy. He was correct. Warburg was the intellectual engine of Jekyll Island. He brought the technical knowledge of how the Bank of England worked, how the German Reichsbank functioned, how a modern monetary system could flex with the needs of a growing economy, and the determination to transplant that architecture into American soil. The train moved through November darkness, past Philadelphia, past Washington, through the Carolinas, into Georgia. 6 men, first names only, a borrowed shotgun, and the future of American finance riding in the same private car. They arrived on Jekyll Island and went directly to work. Frank Vanderlip described what followed in his 1935 autobiography, From Farm Boy to Financier. We had disappeared from the world onto a deserted island. We put in the most intense period of work that I have ever had, but it was also entirely thrilling. Paul Warburg later called it a desperately trying undertaking. The men woke before dawn and worked deep into the night. They ate their meals together. On November 24th, Thanksgiving Day, they sat down to a dinner of wild turkey with oyster stuffing in the grand Jekyll Island dining room, in the middle of secret negotiations that would reshape American civilization. Then they went back to work. They disagreed sharply on details, how much power should flow to the central authority, how interest rates should be set, what counted as acceptable collateral for emergency lending. Vanderlip and Warburg clashed on the architecture. Aldrich pushed for speed. Andrew, the Treasury man, insisted on political feasibility, but strip away the arguments, and they agreed completely on the fundamental architecture. The American economy had no flexibility. When it needed money, there was none. When it had too much, there was no way to pull it back. The system couldn't breathe. Every panic followed the same pattern: fear, withdrawals, bank failures, businesses destroyed, families ruined, and then more fear. The same cycle over and over with no way to stop it. The solution they designed was architecturally elegant and deliberately disguised. They could not name it a central bank. Paul Warburg understood this more clearly than anyone. The solution was to make it look like something else. Not one central bank, 12 regional banks spread across the country: Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, San Francisco. To the public, it would look decentralized, democratic even. But make no mistake about what was actually designed in those 9 days. The interest rate, the single most consequential number in the American economy, would be set collectively as a unified system. Warburg confirmed it decades later in writing. The matter of a uniform discount rate was discussed and settled at Jekyll Island. One rate, for all 12 banks, decided at the center. That rate, what we call the federal funds rate today, is the same mechanism that determines your mortgage payment, your car loan. The 23% average interest rate on American credit cards right now, whether your employer can borrow cheaply enough to keep you hired or has to lay you off. whether the housing market opens or freezes solid. The most intimate financial details of 335 million American lives flow from a mechanism designed in 9 days on a private Georgia island in November 1910. By the time they finished, they had drafted a complete blueprint for America's central banking system. And then the 6 men made one final agreement. No one would ever know this meeting had taken place. The plan was presented to Congress in January 1911 as the product of the National Monetary Commission. Aldrich presented it as the result of years of bipartisan study. He did not mention Jekyll Island. He did not mention the 9 days, the 6 men, or anything that happened on that island. The reaction was fierce. Democrats attacked it as exactly what it was, a Wall Street blueprint for a system that Wall Street would control. Senator Robert La Follette of Wisconsin called it a scheme to hand control of America's money to New York financiers. Congressman Charles Lindbergh Sr., father of the famous aviator, called the Aldrich Plan the Wall Street Plan and warned it would hand control of America's money to a purely profiteering group. The plan failed to pass, but the men who wrote it had anticipated failure. They regrouped quietly, methodically out of public view. In 1912, the Democrats swept the elections. Woodrow Wilson became president. Nelson Aldrich chose not to seek re-election. His association with Wall Street had become too visible. The Aldrich Plan appeared dead, but it was only being renamed. Democratic Congressman Carter Glass of Virginia took the lead on the new legislation. The language was rewritten in progressive terms. Public oversight was emphasized. The Aldrich name was stripped from every page, and President Wilson, who privately assessed the Jekyll Island plan as 60 to 70% correct, pushed it through Congress using his full political capital. On December 23, 1913, 2 days before Christmas when public attention was elsewhere, Woodrow Wilson signed the Federal Reserve Act into law. Frank Vanderlip confirmed the outcome in his autobiography, plainly and without apology. Although the Aldrich Federal Reserve Plan was defeated when it bore the name Aldrich, nevertheless its essential points were all contained in the Federal Reserve Act as it was passed. The Jekyll Island Plan had won, disguised, renamed, stripped of its author's fingerprints, but structurally intact. In 1916, journalist Bertie Charles Forbes, who would later found Forbes magazine, published an article revealing that the Jekyll Island meeting had taken place. It was largely ignored. The participants said nothing publicly. The secret held through one world war, through the Roaring Twenties into the Great Depression. The participants didn't acknowledge Jekyll Island until the 1930s. By then, the Federal Reserve was already one of the most powerful institutions in the world. And in 1929, when the stock market collapsed and the Great Depression began, the Fed made a series of decisions, raising interest rates, contracting the money supply, that economists and historians today widely agree made the crisis significantly worse and significantly longer than it needed to be. The institution born in secret had become too large, too embedded, and too powerful to question. So does it matter that the system controlling your money was designed in secret, on a private island, by men representing the largest banks in America? That is the question this story leaves you with, and it is a question worth sitting with. But here is what the Jekyll Island story reveals. The system devised on that island was deliberately constructed to be institutionally independent of electoral politics. The 12 banks of the Federal Reserve are not government agencies. They are private corporations, owned by their member banks. The chairman of the Fed is appointed by the President of the United States. But the Federal Reserve's major decisions on interest rates are, by definition, shielded from the direct will of voters or elected representatives. Right now in 2026, a sitting president is publicly demanding that the Federal Reserve cut interest rates. The Fed chair is publicly refusing. It is the loudest, most visible clash between elected political power and unelected financial power in living memory. Every journalist covering that story frames it as a modern conflict. It may seem like something new, but it's not. The men on the island deliberately built the distance between the White House and the Fed. The systems that shape your financial life were designed by specific people with specific interests at specific moments in history, sometimes in a marble room in Washington, and sometimes on a cold night on a secluded island in 1910. Jekyll Island is open to visitors today. You can drive to Brunswick, Georgia, take the ferry across, and walk through the very rooms where it happened. The state runs it as a public museum and nature preserve. There are no bronze plaques marking the meeting room, no monuments to what was decided inside those walls, no historical markers, just the rooms, the original furniture, and the weight of what was decided in them. Decisions that still govern the most powerful financial system in the history of the world. This has been the Financial Archaeology. Subscribe and stay with us. The next dig is already underway.